Hello, welcome to Any Answers Answered for March 2018. A couple of very interesting questions with actually rather more of an answer than we might have initially thought when we first read the questions. The first question is from Millie1 and it's to do with employment allowance. The question is, if a partnership converts into a limited company, is it entitled to a second hit of employment allowance? The revenue guidance appears to refer only to a balance of the partnership claim. Only change in staff, she specifies, is that the partners have become salaried staff. So the question effectively, if we change our business structure halfway through a year, can I get a second £3,000?
Probably not.
Probably not.
But like everything else in tax and national insurance, it all depends. What we need to do is look at the legislation. The £3,000 employment allowance reduces the employer's secondary class 1 liability. And if you take a sole trader or partnership that has claimed that £3,000 in respect of secondary liabilities of employees up until the date of incorporation, and typically the £3,000 would be recovered as early as possible, well, is the new company then able to claim any employment allowance for the remainder of that tax year? So let's suppose that there's an incorporation on the 1st of January 2018. For the 2017-18 tax year, the unincorporated business has claimed the full amount, let's say, of £3,000. It's a limited company from 1st of January 18. Can that limited company claim any employment allowance for 2017-18? Well, the legislation is in the National Insurance Contributions Act of 2014, and in particular in section 2, where, if I get it on my screen, we need to look at subsection 5. This deals with transfers of businesses, and it tells us that if a business or part of a business is transferred to a person P in a tax year, which is what happens here, then liabilities to pay secondary class 1, so the class 1 secondary against which we set the employment allowance, will be excluded liabilities. So we won't be able to set the employment allowance against it if they're incurred in respect of an employed earner who is employed, wholly or partly, for purposes connected with the transferred business. So if all the employees in the limited company, post-incorporation, are performing duties connected with the transferred business, whether they are old employees of the unincorporated business or new employees of the limited company or the previous owners of the unincorporated businesses who become directors of and employees of the limited company, well, in each of those scenarios, we're looking at excluded liabilities. So although the limited company is entitled to a full £3,000, it won't be able to use it because all of the secondary will be an excluded liability. If the newly incorporated limited company were to carry on a different business alongside perhaps the transferred business, then employees involved in that, their secondary liabilities would be non-excluded, and so we could get the employment allowance there.
So just say the last bit again.
If we had in the new company, in addition to the old business being carried on in the new company, a new business that had not been carried on, then the secondary liabilities of any employees who were involved in the new business but not the old business wouldn't be excluded, and so the company would be able to qualify for the £3,000 employment allowance there.
Fantastic. I have a real life example for you.
Oh, well, tell me.
So a partnership which was selling cars has now decided to do servicing as well. As part of the deal, they have to do that through a corporate structure. So they've decided to incorporate the business, and they will then be car sales and also car servicing. That could potentially be a situation where that's a new aspect to the business, a new
Absolutely.
trade.
If they take on a maintenance engineer as a new employee who is not at all involved in selling, or even if one of their old employees no longer has anything to do with selling, but is now purely on the maintenance side, servicing side, then their Class 1 secondary will not be excluded and the company can claim the £3,000.
So, as you said at the beginning, the answer to Millie's question is probably not, but possibly.
It's a very interesting question.
Very interesting.
We've not talked about employment allowance for a while. A further point would be, as we come up to the tax year end, if you're going to start a new business with employees with significant amounts of secondary, then you've got an opportunity to get the full 3,000 in 17-18, as well as then a full 3,000 in 18-19. It's interesting that we've only got one answer posted so far. I mean, this question was only posted a couple of days ago, and the only answer says no. In answer to the question, is it entitled to a second hit? The answer correctly on my analysis is no. Any unused allowance is lost, but it doesn't go into the sort of detail that you need to go into.
Very important.
It's not quite as simple as that.
Employment allowance is a wonderful thing to get this £3,000, but we have to make sure we meet the requirements. Our second question comes from simply a limited director. I'm assuming this is a limited company director who goes on to specify that as sole director of a limited company, their remuneration is not fixed, but defined as a bonus depending on the company's profits. The condition for receiving the bonus is that all of it will be contributed to my SIP. The company makes a pre-tax profit of £500,000, hence I receive a bonus of £500,000 paid into my SIP by the company. Does the company have to pay national insurance on this payment? If not, it's the perfect solution for reducing corporation tax to zero. Now, let's deal with that part first. There is a secondary part to it as well. I can't understand what they're saying. Are they saying that they get a bonus and they then choose to pay that themselves into the pension? I think it's saying that actually they don't get a bonus. Instead of getting a bonus, the company pays money into the pension. Let's work on that basis. The company doesn't pay them anything, it pays it all into a pension. Do they have to pay national insurance? Yeah,
that must be the case, although actually I would like to deal with the second point first.
Okay, so
because that otherwise we're just disregarding a very important elephant.
Sure, okay. So the second point, which as I read it first and thought, well, hang on, £500,000 going into a pension. The second question, also I understand the annual allowance for pension contributions will not be exceeded here, as it's not more than 100% of my earnings. Therefore, no charge will be applied to this contribution. Is that correct? Nice and easy?
No. The annual allowance is £40,000, and that applies to all your defined contributions and accrued benefits in defined benefit schemes. And although it is possible to use brought forward unused relief from the previous 3 tax years, disregarding that, nobody's going to be able to get tax relief on more than that 40,000. So the error in the question, if you like, is in thinking that because it's an employer contribution, you can get more than the annual allowance, or it doesn't count towards it. Of course, that 40,000 figure is restricted if your income goes over 150,000. And for the purposes of the tapering down to 10,000 of the annual allowance of 40, the employer contributions are treated in a different way from your own contributions, but that's a different story. So the first point to make here is that the questioner is wrong to think that they can get tax relief on more than 40,000 a year, assuming no unused relief brought forward.
Okay, so if he were in a position to claim 40,000 of it, the other 460, we'll assume nothing brought forward, the other £460,000 would not qualify for the relief.
That's correct. And if the company were to make that £500,000 payment, then it would give rise to an excess pension allowance charge, and the individual would then have to include that in their self-assessment and pay tax on that excess amount.
We should answer the first part of the question as well, even though I think it's probably irrelevant in this story because it's not going to work for corporation tax relief. The £500,000, if it had been paid directly by the company into a pension, then it's correct. There would be no national insurance on that. It would only be national insurance if it was paid to the individual and then he went on
to pay it. That's right. And there is potentially a benefit in what he's suggesting, but nothing like as much of a benefit as he would like to think. Just before answering directly your last point, remember also that if a company does pay a pension contribution like this on behalf of a director, then the revenue will ordinarily accept that the payment of that pension counts as earnings, because the questioner is right to recognise that there's a limit alongside the 40,000 annual allowance. The contribution mustn't exceed your earnings for that particular tax year. And so if he's got no other earnings, does that mean that the whole of the $500,000 is an excess? No, it doesn't, because the revenue would accept, unless it is very excessive, which this might be, that the payment of the pension contribution counts as earnings. So where we are with it is that if they do pay the $500,000, there's no NI, but there will be an excess allowance charge. The pension fund itself will be significantly overfunded. We need to think about the lifetime allowance, because he's going to be up against that very quickly if he's paying that sort of level. And fundamentally, it's not a great idea at all.
No. Just to confirm finally on that 40,000. So if I have no income at all, how much could I pay into my pension? And the answer is £3,600. That rule still applies. If I then have earnings of, let's say, 20 or 30,000, then I could pay up to 20 or 30. Once I go past 40, though, 40 is the maximum. Once I go past 150, I then start to lose it to £1 for every £2 over, unto a minimum of £10,000. Once we get to £210,000, that is how that sort of entitlement goes up, stays at the same, and then starts to fall away again. So $500,000 simply not going to work for you, limited director, but a nice try. Do ask your questions in the future. Perhaps next time on Any Answers Answered, we'll be discussing your question. For this month though, bye-bye.